Hi, Spencer here, and today I'm going to talk about one of the very interesting popular price patterns called the wedge pattern. And the reason why this pattern is very useful is because it allows you to predict reversals before they happen so that you can see it coming and you can take the action to trade the reversal. So what you will learn in this short video tutorial, the underlying psychology behind the chart pattern, and why the wedge pattern is a good early indication of potential reversal moves, and how you can differentiate the wedge from trend channels, because that's a question that I get quite often from my students, and also some effective trading strategies that work for this pattern. So I'll be sharing 3 strategies and how you can increase the odds of trading this pattern. So some tips from the practical trading, how you can tackle this pattern. Okay, so earlier on I talked about the 2 main types of patterns, reversal patterns and continuation pattern. So the wedge will fall into the classification of the under the reversal pattern. Okay, so the 2 main types of wedges is the rising wedge, right, which is the bearish version, and the falling wedge, which is the bullish version. Okay, so there's a bit of sometimes people tend to get confused because they think that the word rising is bullish, right? So this is a bit of it's a bit of the opposite, right? Because a rising wedge is bearish, whereas a falling wedge is bullish. Okay, so this is something that you need to keep in mind whenever I use the term rising wedge and falling wedge. Okay, so a bit of confusion arises between being able to differentiate the wedge uh, versus the trend channel. Okay, so I'm going to explain it clearly in this slide. Okay, so the first thing you see over here is the uptrend channel, right? So it's a series of higher highs and higher lows, right? So very nicely you see the price being sandwiched between usually 2 parallel sloping lines, right? So the trend, if it's very steady, it will keep between the 2 lines and continue to bounce off the top and bottom. So you have a uptrend channel. So that is a sign of bullishness. Okay, whereas for for the wedge, right, the main difference is that instead of having 2 parallel sloping lines, right, you have 2 lines that are both sloping up. However, the gradient of both lines are different, right? So you notice that this line is steeper, right, and this line is less steep, right? So as a result, what happens is that you see price sort of gets sandwiched. Price sort of gets sandwiches between the 2 lines, right? And at some point of time, the price eventually breaks down, right? So when it breaks out of the compression, right, that is where you will start to see a decline in the price, right? So that is the difference between an uptrend channel and a rising wedge. Okay, so when we talk about so why this is bearish, right? Later on, I will talk a bit more about under the psychology. Okay, so for the bearish, for the downtrend version, right, you can see that this is a downtrend channel, right, where prices are gradually going downwards, right, in parallel sloping lines, right. So this is indeed bearish when you see this happening. Okay, and for the falling wedge, right, the same thing. Instead of having 2 parallel lines, you get one line that is steeper and one that is less steep, right? So what happens is also price gets squeezed out near the tip, right, and which leads to a breakout, right? So that is why the falling wedge is bullish, right, whereas the downtrend channel is bearish. Okay, so what this would look like on a real chart, right? This is the rising wedge, an example of rising wedge, right, which eventually leads to a breakdown of price. Okay, so you can see, right, this is where the breakout happens, right? So price, this is the wedge, right? Price is moving, right, and then it at some point of time breaks down from the rising wedge. So you can, if you recall, right, this is the line that is steeper and this is the line that is less steep, right, which causes price to get squashed near the tip. Okay, same for the falling wedge, right? So now remember, falling wedge is bullish, right? So you can see prices moving down here, right, getting squished, right, between the two lines, right, and at some point it breaks out. Okay, so that's for the falling wedge. Okay, so why, right, I know you have been waiting for this part, right? So why is it, right, that a rising wedge is, is bullish, and why is a falling wedge why is a rising wedge bearish, right, and why is a falling wedge bullish, right? Because when you look at the picture, right, when you look at the pattern, right, logically it seems that it's trending downwards, right? Because we have learned so far that you want to follow the trade with the trend, right? So it looks like it's making like it looks like a rising wedge is making lower highs and lower lows, right, trending downwards. So it looks intuitively you think it's bearish, right, and a falling wedge is making higher highs and higher lows, so intuitively you think that it's bullish, right? But the reason why, right, is because the for rising wedge, the buying pressure is getting weaker and weaker, right, with each new high, and then you have more and more sellers stepping in, right? So what I mean, right, so if you look at, we go back, right, to the chart of the rising wedge, you can see that at each point of time, right, so the price comes down and then it goes up, right? So at this point of time, it actually makes a new high, right, relative to this high, right? So this is your new high, right? And then it goes down again, right, and then makes a new high, right? But you notice that with each new high, right, it's sort of getting weaker and weaker, right? Because in a normal uptrend, right, you each high, right, you can see that it's pretty the distance, right, between the highs, right, are either increasing, right, or pretty consistent, right? Whereas down here you can see that the distance, right, between the highs are getting less and less, right? Which means that that means that at every high, right, there are actually more and more sellers, right, more selling pressure that's stepping in, right, until some point of time the selling pressure overwhelms, right, and leads to the bears taking over, right, from the bulls, right? So that leads, right, to an eventual fall in the prices. Okay, so that is the main rationale, right, behind this pattern of why it is a bearish pattern. Okay, the same reason, the same theory applies, right, to the falling wedge. Okay, so you see that every time it makes a new low, right, it actually gets the weaker and weaker, right? So how you can tell that it's getting weaker is because you can see that the two different lines have different gradients, right? If they are both sloping the same parallel, then you know that the strength is the same, right? But you can see that the top line is sloping more, which is more bearish, and the bottom line is sloping less, right? Which tells you that that when there are more buyers stepping in at the bottom, right? That's why the gradient is much less, right, over here. Okay, so eventually the opposite side takes over and leads to a strong reversal move, right? So that's why rising wedge is bearish, right? Falling wedge is bullish. Okay, so what are some of the trading strategies that you can use to trade this pattern? Okay, so there are three. Right, the first is you enter before the breakout, so as the pattern is forming. The second is you enter during the breakout, right, at that point of the breakout. And number three is you enter after the breakout. Okay, so I'll go through each one. The first is entering before the breakout. Okay, so the good thing about this pattern is that you can actually see it forming, right? Meaning it takes quite a while for the pattern to form, and you can see that it consolidating. So at some point of time, after having seen many ups and downs, right, when it's nearing the tip of the pattern, right, the pattern definitely will have to break, because it cannot keep going indefinitely, because the longer it goes, right, the smaller, right, it will become. So at some point of time it will try to break out, right? So once you see it forming, right, for example here, right, you can, any point when it's inside, maybe when it's inside this point, you can consider taking a short setup, because you know that this is a rising wedge which is bearish, right? So you can consider maybe, taking a entry price, right, over here, right, and then you just place your stop loss right over here, or maybe above this height here, right, you place your stop loss, right? So your risk, right, is not a lot, right? It's just here, right? And if the pattern does break out, right, you can see that your potential target, right, can be quite a lot, right? So that makes the reward to risk good, because there's a high reward, right? There's a low risk for this trade, right? So this is how you can trade it, entering it before the breakout happens. Of course, the risk, right, for this is that the breakout may not happen, right? But even if it doesn't happen, it will tend to go either within a range, and also if it goes within a range, right, then you can just close the position. If it just continues, right, to go sideways, right, you can just close the position. You probably won't lose much, right? You may even make a small profit. Worst case scenario, if it hits your stop loss, right, your risk is still very small. Okay, so that is the first strategy. Okay, the second strategy is to enter it during and after the breakout, right? So if you are, if you are afraid that that if you enter early and it may not break out, right? So the next thing that you can consider doing is to enter it, is to wait for the breakout to happen before you enter the position. Right. So for example, when the breakout happens, that means that this line, this is the point, right, where the breakout actually happens. So what you want to try to do is to enter as close as possible, to the breakout, at this breakout point, right? So you can enter anywhere, within this zone, right? Let's say you place your, let's say you enter, your entry price is here, right, and then you will just place your stop loss, right, at the lowest point, or the most extreme point of the wedge, right? So your risk, right, is probably something like that, right? Whereas your target, right, is the is a lot further away. Right? So in this aspect, your reward to risk, right, is also very good for this trade. Okay, and the third option is to enter after the breakout, right? So meaning, you wait for the after this breakout has occurred over here, right, you can wait for the next pullback, right? So the first pullback will actually be down here, right? After this breakout happens, this will be the first pullback, right? So you want to enter somewhere here, right? So when you enter here, you can either place your stop loss below the swing low here, right, or more conservative, to use the extreme low point, right, below the extreme point of the wedge, right. Your stop loss and also your target, right, will be the same as the previous example. Okay, so that is the three strategies, right, that you can use to enter before the breakout, during the breakout, or after the breakout. Okay, so how do you know when to take profit for the wedge? Okay, so the wedge also has a technique that you can use to measure, to do a price projection from the point that it breaks out. So in this example, what you want to do is to look for the widest part, or the tallest part of the wedge, right? And to take that and to project it from the breakout point. Okay, so in this example, this will be the minimum target, right, for the wedge, right? So remember early on, right, if you make your entry here, right, and you put your stop loss here, right, you will have a reward to risk ratio of at least 2 to 3 times, right, your risk. Okay, so some additional tips from the trading desk on how do you trade this pattern. Okay, number one, trade with the larger trend. Okay, so it always pays to know what is the bigger trend. All right, so for example, if it's in an uptrend market, right, you want to look for falling wedges, right, to enter, because even if you are wrong, right, you are still with the trend, so there's a high chance that the trend will the larger trend will resume, right, even if the pattern turns out to be wrong. Okay, so which leads to the next part. If the wedge happens to be part of a larger pattern, right? So for example, if it's a pennant, right? So the pennant, if you recall, it is like a small triangle. The pennant, right, is like if this is a price move, right, and then the pennant is like a small triangle, right, and then followed by another strong move, right? So if your wedge is at this point, right, meaning if this is a prior strong uptrend, right, and then you see a wedge forming here, right, it's a good chance to to enter, right, because you know that after that there's going to be a strong move upwards. Okay, and the next one is to enter near support resistance or moving averages, right? So for example, if your wedge, right, if let's say this is a wedge, right, and you're looking to buy, right, if you're looking to go long, right, it's also advantageous if say there's like a strong support over here, right, or if there's a a moving average, right? So when you buy, right, you have more confluence of factors that increase the odds, right, of the price continuing to move upwards. Okay, so to sum up, right, the larger the pattern, right, so the larger the wedge pattern, the larger the reversal is going to be. So if you see like small wedges, right, there's a high chance that it's going to be, that is part of a larger pattern, right? So if you see a small wedge, it could be a pennant, right, on a higher time frame, and so that will just be a continuation of the larger trend, right? But if you see very big wedges, right, like major wedges, then it could be a major trend reversal, on the time frame that you are looking at, right? So this is something that's very important, is to which is to see the context, right, by looking at the size of the pattern. Okay, so that's it for this video, right? And I hope you have learned something useful today, right, from this video. And if you like it, right, please do subscribe for our YouTube channel, right, because we do have a lot of new videos coming up, right, and we have weekly videos. So just click the subscribe button, and I will see you in the next video.